You know, if you've spent any time in crypto, you know the drill. Chasing yield can feel like a full-time job, right? One minute, a protocol is just printing these amazing double-digit APYs, and the next, poof, the market shifts and that yield is gone. So what if there was a way to find stable, competitive returns that didn't just vanish when things get choppy? Well, that's the billion-dollar question we're going to dig into today.
Exactly. I mean, that's the hunt we're all on. The thing is, most yield strategies in DeFi are kind of one-trick ponies. They might rely completely on something like positive funding rates, which is basically just getting paid to be bullish in a bull market. But the second that sentiment flips and those rates go negative, well, the yield dries up instantly. And it leaves all of us hopping from protocol to protocol, always chasing the next hot thing. And this is the very problem Falcon Finance was designed to solve. It's a protocol with a really simple but honestly a super powerful promise: to build a system that can turn almost any asset you own into a productive, yield-earning dollar and do it all on-chain. And this mission statement, your asset, your yields, it really gets to the heart of their philosophy. It's this idea that your assets, whether it's your Bitcoin, your ETH, or even a tokenized piece of real estate down the line, they shouldn't just be sitting there collecting dust. They should be working for you. And Falcon wants to be the engine that makes that happen.
So how is Falcon actually different in practice? Well, this comparison kind of lays it all out. You see, most protocols are like fair weather sailors. They're great when the sun is shining, but they rely on one strategy that only works when the market's hot. Falcon is trying to be an all-weather vessel. By accepting way more types of collateral and using a whole bunch of different strategies, it aims to generate yield consistently, whether we're in a bull or a bear market. And that right there is a pretty fundamental shift.
Okay, so that all sounds great in theory, but how does it actually work for someone like you or me? Let's walk through the whole journey from start to finish.
All right, so here's the bird's eye view of the entire process. And hey, don't worry about every single box on here. The key thing to see is the flow from left to right. You start with your collateral, you mint Falcon's dollar, and then you stake it to start earning. We're about to break down those key steps right now.
And here they are, the core actions. It's a simple three-step dance. First, you collateralize your assets. That just means you lock them up in the protocol as security. Second, you mint USDf, which is Falcon's own synthetic dollar. And third, you stake that USDf to get SUSDF. And that's where the magic really happens. So to really get this, you gotta know these two tokens. USDF is the stable dollar. Think of it as your entry ticket to the system. But the real action, the important one for earning yield, is SUSDF. You can think of it like a receipt that actually grows in value over time. As the protocol strategies are out there making money, each one of your SUSDF tokens becomes redeemable for more and more USDF. That's how you actually see your yield grow.
Okay, so where does all that yield actually come from? Let's peel back the curtain a little bit and look at the engine that's powering this whole thing, what they're calling the secret sauce. Now this chart, this is where the theory smacks right into reality. Just look at that orange line. That's Falcon's multi-strategy approach. Now, compare it to the gray line, kind of hugging the bottom there. That gray line is a standard single strategy, just ETH funding rate arbitrage. The gap between them? That's not a small improvement. That is a completely different class of performance, and it shows you exactly what diversification can do. So how does it get that kind of outperformance? Well, it's by combining some serious institutional-grade strategies. It takes in a whole bunch of different types of collateral, everything from ETH to eventually real-world assets, and puts it all to work. But what's really crucial here is it uses strategies like negative funding rate arbitrage. That means it can actually make money when everyone else is bearish and losing. You combine that with other clever strategies like cross-exchange arbitrage, and you create that all-weather engine we were talking about before. Of course, we all know in DeFi, there is no such thing as a free lunch. Every single opportunity comes with risk, so it's absolutely essential to understand both sides of the coin before you even think about getting involved.
And here's an honest look at those trade-offs. The upside is pretty powerful, right? You're putting lazy assets to work, you're getting access to professional-grade yield. But the risks are just as real. You've got smart contract risk, the risk that your collateral's value just plummets, or the big one, the risk that the stable dollar itself depegs. It's the classic DeFi dilemma. With higher potential reward comes way more complexity and risk compared to just holding a coin.
So, to try and counter those risks, Falcon has built what looks like a multi-layered defense system. You've got dual-layer monitoring to protect against market volatility. They use qualified custodians to reduce the risk of something going wrong with an exchange. And for transparency and trust, they have an on-chain insurance fund and regular third-party audits. It's all about creating a system of checks and balances.
All right, so let's pull all of this together. At the end of the day, what's the big picture takeaway here?
Even the token allocation tells you a story about their long-term vision. Just look at this. A combined 59%, the vast majority is dedicated to the ecosystem and the foundation. That's capital for growth, for integrations, for operational stability, not just for short-term payouts. The whole structure is clearly designed to build a sustainable protocol that's here for the long haul.
And this slide really shows the true endgame. The goal here isn't just to be another DeFi protocol. It's to become a fundamental bridge between the old world of traditional finance and the new world of DeFi. By eventually bringing in assets like tokenized T-bills or even physical gold, the vision is to create a truly global, decentralized, and resilient synthetic dollar.
Which, brings us right back to our final question. Falcon's approach is clearly a huge step forward from the simple yield farms of the past. But creating a whole new financial primitive, well, that's an incredibly ambitious task and it's filled with risk. So what do you think? Is this the new benchmark for on-chain yield? Or is it another fascinating chapter in the bold, ongoing experiment that is DeFi? That's the question we're all going to see answered in the months and years ahead.